Hello, everyone. My name is Neil Ross. I'm Managing Director, National Sales with Ninepoint Partners, and we're very excited to have you all here today to hear from Eric Nuttall and also to enjoy his presentation. The oil party has just begun. I'm going to turn things over to Eric. I think most people on the call will know him. He's one of Canada's foremost experts on oil and gas investing. Eric has been with our firm and then with Ninepoint and with our predecessor firm and been a PM since 2003. I think that everyone that has followed him on Twitter or followed him through different media knows that he brings a depth to the space that is rarely paralleled. Eric is a senior portfolio manager and also a partner in Ninepoint. And as I said, we're happy to have him here today. Eric, without further ado, I'm going to hand things over to you. I advanced the slide for you too. Sorry about that.
Perfect. Thank you, everybody, for joining. We've got great attendance. Obviously, interest in the sector is growing. I know you would know that in the share prices, but perhaps by the time I'm done, we'll all be a little more excited and have the way to incite interest in the sector a little bit more. So we've got a few key things. Personally, my own attention span is about 20 minutes, give or take. So I'm going to aim to speak for no more than 20 minutes. And my main goals is to give a refresh on our oil macro. The last time we did this was back in March, so things have obviously changed since then. Pretty proud of everything that we talked about back then has gone from a prediction to reality. So I want to give the roadmap that I'm using for the remaining 6 odd months of this year, and also what our thoughts are for the next couple of years. The next thing I'm going to address is the profound mispricing in energy stocks. We're up 92% year to date, so that mispricing has changed a little. But despite the rally in energy stocks, valuations today are cheaper than where they were beginning of this year, given the move in oil prices. And I really don't think that's well known. So those are the two primary goals. What's the road ahead look like? Very different than the one we've been stuck on for the past 5 years. And how are energy investors going to make money through that? And then I'll give you a short commercial about the fund that I run, and hopefully we'll do some questions after that. The goal is 30 minutes and no more. So this is my COVID slide, and I like everybody, I'm really looking forward to the time when we don't have to speak to COVID, because we're rapidly entering into a post-COVID world. What I wanted to show you was very clearly the damage that was done to oil and oil inventories last year is over. The oil market has largely healed. We measure that on the left. This is the OECD inventories courtesy of the IEA, admittedly 2 months old. So, however, this is what consensus uses. Inventories are now both below the trailing average using 2020, which we shouldn't really do. But more specifically, we should use what OPEC uses, and that's the trailing average between 15 and 19, and we're at a deficit to that level as well. More importantly, we use Kepler data, so we pay a small fortune to get access to their data. Kepler uses satellite imagery to monitor every vessel in the world and every onshore storage tank in the world. And by doing so, we can get close to real-time inventory data. And I want to remind you, like a mentor of mine from years past was big on tracking inventories, because inventories are the nexus between supply and demand. Getting real-time data on demand, very tricky. We can try to use things like Apple and TomTom data, et cetera. Getting real-time data on supply outside of the United States is challenging, but inventories never lie. And so we track inventories, and we're willing to pay for the very best quality data possible. And what Kepler data shows us is that here, the damage done last year, where inventory swelled by about 475 million barrels, we are now in a sharp deficit to last year. The same inventory trend has occurred and will continue to occur in the United States, both on the left, where crude inventories relative to the trailing 16 to 19 average is in a sharp deficit and growing. The same is true when you want to take a more holistic measurement of the health of the US energy market by measuring not just crude, but gasoline and distillate, the big three. And these are charts that, for those of you following on Twitter, we try to put up every week or so. So the market is in deficit. More importantly, where are we headed? What is the path that we're on? Where is it taking us? So we just had OPEC meet on Monday. Oil sold off coincidentally, and I'm going to address that in a few slides, less so than I was originally intending, given that oil's largely repaired a lot of the damage that we saw. But the incremental barrels that OPEC is adding onto the market should not be interpreted as a negative event for the energy market. It is, in fact, a very, very bullish signal. So even though OPEC is adding about 400,000 barrels per day per month from now until April, and then that goes up slightly, why are they doing that? Is it because they're pushing barrels into the market, or are they allowing the market to pull barrels from them? Are they going to risk all of the efforts over the past year to year and a half that saw the oil price rally with compliance higher than almost anybody thought possible? Are they now in a position where they want to throw that out the window just to be able to jam the market with barrels that are not required? You know the answer to that, and it's very clearly no. And so while they're adding barrels on because it's in demand from customers, it's keeping the market in a deficit and resulting on the left-hand slide, we show that inventories will end this year at a multi-year low. And so again, as inventories fall, that's putting very strong upward pressure, or at least fundamental support on the oil price. We think that $70 is a very strong fundamental underpinning, especially on the right. We show here the surplus relative to the 17 to 19 average has been collapsing, and we see normalized inventory levels in the coming months. Again, very, very bullish for oil. So let's address this week. The timing of this call is rather good. So we come into work on Monday, oil falls 8%. It happens to be after the OPEC meeting. And the media, they have to try to explain these things, and they say, well, geez, it's a negative. OPEC's adding barrels, etc. The market doesn't like it. Oil's selling off. I want to remind everybody that there's the physical market for oil, which is the largest commodity in the world. And then there's the financial market for oil, which is 32 times bigger approximately than the physical market. And so in the very short term, there can be these wonky times where the price deviates from fundamentals. Ultimately, fundamentals matter at the end of the day. It's why we spent so much of our time last year when people were panicking, the oil price sold off, we went negative, et cetera, for a couple nanoseconds. Clearly, the fundamentals didn't support a negative oil price, but there we were for a short period of time. So this week, it's very clear that oil is being used as an instrument to get leverage to the inflation or deflation or reflation trade. The correlation to the 10-year is uncanny. You can see the peaks and troughs are identical. And so while the rise in the Delta variant is spooking people, even though things are getting better in the UK already, like the 7-day trailing average is falling, it gave people an excuse to sell, liquidate, net spec length, etc. But the fundamentals changed in 2 days. And then this morning, oil is up. And what do you see? Oil is up on headlines of supply risk. Well, nothing changed yesterday versus today to have oil up, sharply on that. That's a very long-term theme. So at times when the market gives you these gifts, it's my job to take advantage of it. And that's what we were doing on Monday. We were buying stocks, and we continue to buy stocks at levels that we absolutely don't understand how we're able to. I'll touch on that in a little bit. It baffles my mind, frankly, that people are not seeing what we see yet, but it's inevitable that they will. And so here are a couple snippets from various brokers and analysts that we use, some whom we respect greatly. Energy Aspects is a core consultant of ours, talking about one of the tightest summers this year. BMO talking about higher prices. RBC, Mike Trend, really respected barrel counter, talking about how this fear that, oh geez, the UAE and Saudi and what's happening, could they do scorched earth, etc., which we didn't believe in. We used Twitter as a platform to try to remove fears for that. But anyways, the punchline here is the collective narrative is the OPEC deal that was announced on Monday is a net positive for the oil price. But we do know that oil sold off, and now we're back 3 days later. So why did oil sell off? We talked about the Treasury. It feels like there's fears once again for COVID, and I'm going to be very, very careful, as I'm clearly not an epidemiologist or virologist. But what are we seeing? What does the data show? Because I'm a numbers guy. Obviously, we're seeing a rise in case counts in the UK, United States, here in Canada, et cetera, but it's not translating to deaths. And so why is that important? You would think that, if everybody gets the common cold, if people aren't dying from it, we're not going to suffer from the extent of the economic lockdown that we had to endure for the past 15, 16 months. And so why would a non-medical person assume that, the next rise in COVID bouts would be better than the last? It's because we know Those who are most vulnerable to it have the highest levels of inoculation, and vaccines have been proven to be successful. So as an energy investor, you're making the implicit bet that the world's never going to go through ever again what we went through. I've seen a couple estimates where regionally, Australia is under lockdown, and a couple small areas where traffic congestion has moderated slightly. The estimates that I've seen that we're talking like 400,000 barrels to maybe 1 million barrels in for like a 2-month time period, etc. That does nothing to derail our thesis. Inventories remain in deficit. Inventories will continue to fall. And again, that's providing a fundamental underpinning for the oil price. So what really matters? Like, I find so much of my job is try to, for myself, and then I use Twitter as an outlet to kind of keep me, a pointed north. What really matters to the oil price, and why are we in a secular multi-year bull market? Why do we think that oil, by the end of it, it will reach all-time highs? There's really 4 key things. First is persistent increase in demand growth for at least the next 10 years, and I'm going to touch on that. There's a shocking degree of energy ignorance, both in Canada, and we've got people all around the world listening to this, so globally, ignorance about the role of hydrocarbons in all of our lives, the timeline for displacement and replacing oil with whatever else, whether it's hydrogen or biodiesel, or we're not eating cows, we're eating bugs, and no one's consuming plastic straws, etc. There's just a perception that we'll be all driving electric cars tomorrow, and suddenly the demand for oil disappears and we're in the sunset industry. I'm going to try to address some of that. On the supply side, the bullish thesis is really going from demand to more on supply. And so it really starts with the end of US shale hypergrowth. I'm going to talk about why this is a watershed event for the industry, why people just aren't believing it yet, and why it's so profoundly impactful to the oil price. US shale has screwed up every price rally we've had for like almost the past 10 years. Every time you've had a rally in the oil price, you had the guys down in Texas and other areas chasing that and growing and spending like mad. I'm going to discuss why that is no longer the case going forward, why this discipline is in fact the new normal, and the importance that that has on the energy markets. I'm going to talk about OPEC. While they're bringing on production every month, so long as market conditions warrant it, why is that a positive? It's because every month they do that, it brings us closer and closer and closer to the exhaustion of OPEC's spare capacity. I'm going to touch on why OPEC has been struggling with low oil prices for the past 5-6 years. And outside of a very few exceptions like the UAE, where they've been able to grow productive capacity, generally speaking, most member countries have not, as they've had to prioritize social spending. When you're Saudi and you're 90% of your state revenue roughly is oil, well, oil is also accounting for 90% of government costs and social costs and military costs, etc. And so we've just gotten back to the point of allowing these nations to be long-term going concerns. And so without that ability to have invested in new productive capacity, meaningful productive capacity over the past couple of years, we see the exhaustion of OPEC's spare capacity, roughly speaking, by the end of next year, which would be a wildly bullish signal for the energy markets. And then lastly, a theme that we've touched on for a while, and that is the chronic underinvestment by the global super majors. And it's only getting worse or better, depending on your perception of it. ESG pressures are only getting stronger. The pivot from dirty oil towards investing in renewables is only gaining traction. And it's reinforcing a key theme that we've kind of coined, and that is the fear of peak demand is leading to the reality of peak supply. The fear of what oil demand looks like 10, 15 years from now is not impacting investment decisions today, which is having an impact on production today. And so the eco-wokeness and the concern that we're all driving electric cars tomorrow is leading the world into an energy crisis. And so let's talk to demand. There's a massive amount of energy ignorance, and I was thankful to have a biweekly column now on the Financial Post in Canada, where I get to use it as a platform to kind of try to debunk some of the notions, because frankly, it's a very one-sided conversation. There's very few people willing or able or crazy enough to go on and put in the effort and try to talk about the chasm between well-intentioned government policy and our energy reality. And so let's talk about that. How is oil used, and why is oil usage not ending tomorrow? On the right-hand side, we show that 60% of oil demand is for transportation, 40% is not. And so when we talk about non, what are you talking about? We're talking about petrochemicals, we're talking about plastics, we're talking about lubricants, we're talking about rubber, for which there is no real short-term replacement for. And this is in the context where we're all racing towards net zero standing by 2050, but between now and 2050, the world's population is going to grow by roughly 1.4 to 1.6 billion people, occurring in countries where they're not worried about wokeness and net zero, lowering emissions, etc. They're worried about energy access and energy affordability, where we're chasing energy poverty. And so it's very easy to look at the world in the lens of somebody, largely North America, which where most of the people watching today are, when really the population growth is occurring in countries where their primary concern is to stop burning animal dung as a fuel source inside their homes to cook for their families. It's not to build out solar farms or to invest in offshore wind. And so that 40% is really tied to global GDP, population growth, etc. So let's talk about the other 60, transportation. It might shock the average person that when we talk about electric cars and the Teslafication, etc., we're addressing 27% of total oil demand. And so inevitably, we'll all be driving electric cars if government policy comes to pass. And yet the timeline to achieve that, ignoring all of the barriers, such as, RBC put out a good report talking about copper, where between now and 2030, we're going to have like a 30% deficit just in copper, which is, a little critical to build out the infrastructure required and batteries and tech and such. When we talk about hydrogen, we're all going to be using hydrogen for heavy hauling trucks and maybe even planes and seaborne vessels and whatnot. But the timeline to get there, I had to endure like 6 different hydrogen conferences this year to make sure I wasn't missing something. And we're talking like 2035, 2040. Well, we're 2021, and yet the fear of displacement is impacting investment decisions today. And so there's a great model on the left that I wanted to share. It's by Bob Brackett of Bernstein, whom I think does really, really great innovative work. Anybody on the buy side watching will likely know Bob's work, and if not, you should. So very differentiated. He took a stab at modeling out global oil demand growth. And he admits, I admit, there's about 1 trillion different variables you can use. But this is his model to say, okay, let's hit every government objective, all of the countries, including Canada now, where I'm not going to be able to buy an internal combustion engine in 2035, California, UK. Let's assume we adopt hydrogen, which is shown on that kind of aquamarine line, etc. Let's just go nuts. Okay, this is like the most conservative model you can build. And Bob's estimate is demand growth continues out till 2035. Okay, so we got 14 years of continued demand growth. And let's see, that gets us to 120. So we have to grow production to match demand between now and then by 20 million barrels per day. I would pose the question to you. In an era where OPEC has limited capacity, maybe they can grow, but it takes time, where investors are saying, don't you dare grow, use free cash flow for buybacks, where US shale hypergrowth is over, where I estimate that it can grow by about 500,000 barrels per day per year sustainably. Where is that 20 million barrels per day going to come from? Also note, when we reach peak demand, what happens? Does it fall off a cliff and demand ends the next day? No, it's a very gradual decline. And so a very, very fundamental point that I want to make is, does peak oil demand mean peak oil prices? And the very clear answer to that is no, because what drives price? Demand, but also supply. And so if ESG wokeness is driving companies to no longer invest, the impact on supply can be greater than demand. And so we may arrive at that magical day where demand for oil peaks and starts declining, and yet prices continue to go up. And that will blow people's minds. But are we, in fact, in a sunset industry? Is the long-term merits, so we talk about oil sands, oh my God, you've got 50 years of reserves. Like, what are you going to do? How do I possibly pay for year 20? We're not consuming oil then. This is an extremely profound point that I wanted to kind of bang on. So that's the discussion on demand, on supply. The end of US shale hypergrowth is a watershed event for the sector that is either not understood or not believed. How did shale production growth achieve the rates that it did back in 2018 when it exceeded global demand growth? It was externally financed. Banks were willing lenders. The equity market was wide open. You'd go a company, you'd say, we're going to grow 40%. The market threw money at you. Fast forward to today. Banks want it, both in the United States and in Canada. And you get that by conversations directly with the people making the lending. Banks are under their own ESG pressures to divest and shrink their loan book and show that they're approaching net zero, et cetera. Very difficult to do if you're lending to an oil company. The equity market, I would suggest if any company came out and said, we're going to raise $1 billion because we want to grow production, the stock price would implode and the CEO would be fired. And so this discipline, this requirement to prioritize return of capital is really not from the companies, it's from the shareholders themselves, of which I'm one of them, because we own the companies. It's not the CEOs, it's not the boards. And so our strong message is that there is not a single energy investor in the world, given current valuations, that want these companies to grow. In fact, what we want them to do is stop growing, maximize free cash flow, and take those money and commit them to meaningful share buybacks as a way to rectify the lowest valuations I've ever seen in my entire career. And I'll touch on that in a couple slides. So why do I think that discipline is the new normal? It's because shareholders themselves, the owners of the businesses, are demanding of that. Companies have changed their business models to prioritize return of capital. Now they've implemented variable dividends. Well, investors are just starting to get a taste of what quarterly yield tastes like from the energy sector. What a concept. And once you get a taste for yield, it's very difficult to give it back. Imagine a CEO going, I know we've been paying you on a quarterly basis, but we got to stop that because I want to go grow oil production and repeat the sins of the past. At the same time, compensation plans for US shale companies have changed where CEOs themselves are no longer getting paid. And so I did my own analysis, and I've seen other numbers where the average CEO made 11 to 15 million bucks for the past couple of years. Most of that is bonus, and that bonus you need to check off several boxes. In the past, it used to be growth. Now it's return of capital. It's actually generating returns on the money spent. Like, what a concept. And so the road that we're on now is very, very different than the one we've been stuck on for the past 5 years. The road before was very bumpy. It's full of potholes, and those potholes were US shale. Anytime you get a rally in the oil price, boom, you get 4 to 6 month response in supply, oil rally over. That has been no longer the case. US shale discipline is codified, it's being paid for, and the owners of those companies are demanding it of the companies themselves. And so this is massive because were it not for US shale growth over the past 10 years, non-OPEC production would have been flat. And pre-COVID, demand had grown by 6 million barrels per day. And so were it not for US shale, the world would have already entered into a supply crisis. And so shale, it was a failed experiment resulting in almost $1 trillion of incinerated capital. But the road forward is very, very different. We no longer have short cycle supply. We're now relying on long cycle supply by the very companies themselves who no longer actually want to invest, which I'll touch on. The next component, and this is, I just wanted to give an example of, okay, what did the world look like pre-shale? You know, this is Texas oil production, which I apologize, forgot to label here, but this gives you an idea for, well, what did the oil price look like pre-shale? And $73 between 05 and 010, and then you can see the rise of shale production. Well, we're now in a post-shale world. And frankly, the fundamentals are only better because we've now brought on, and I'm stealing thunder from a couple slides from now, but we've harvested the projects, offshore projects that were sanctioned 5, 6, 7, 8 years ago when oil was at $80 to $100 oil. You look at Canada oil sands, we're challenged in terms of being able to bring on new production because of the ESG worries and government policies, et cetera. So all around the world, supply growth is challenged for a variety of reasons, and yet demand will grow, I think, for at least the next 10 years, and other people whom I perceive not to be energy ignorant would believe so as well. So there's a good, solid fundamental underpinning of about $70, which is the current oil price. Let's talk to OPEC, and I'm going to speed things up because I'm taking a bit longer than I wanted to. So OPEC production, the deal to bring on incremental barrels, it was initially, at least it was presented as being a negative, is actually a very meaningful positive. It brings us close to the exhaustion of OPEC's spare capacity. You look on the left hand, exit this year, bring them to about 34.5 million barrels. That's about 2.3 below what I estimate to be sustainable capacity. You'll note that there have been spikes back in 2016, 2018, and 2020. Well, why did those spikes occur? Each of those times happened to be around when there was discussions of cutting production, establishing a quota system. And well, what's your quota based on? It's based on current production. So magically, oil production from a couple of countries took off. They set the quota and then magically it falls back down. So should we use that peak level as a sustainable productive capacity, or should we average it out where these countries had all the reasons when they were under a quota system to produce maximum capabilities? So that's our best estimate. That excludes Iran. Obviously, Iran is waiting on a new deal with the United States. It seems like that's been pushed off to early next year, maybe Q4 of this year. Regardless, that's about 1.3 million barrels per day, give or take, that the world's going to absorb. And we've got an OPEC deal in place through to the end of 2022 to accommodate that. So that was like the last elephant in the room in terms of potential negative news sources. Those who were saying, Biden softening to Venezuela, well, the last estimate I saw, Venezuela needs $85 billion to increase the productive capacity. Imagine the damage that's been done subsurface, above surface, brain drain, pillaging of equipment. That is not an overnight solution. And then lastly, when we look at the lack of investment in global offshore, now this is about 1 in 4 barrels produced in the world. We're now in year 7 of insufficient investment. It started with the oil price. You get an oil price implosion, companies go into survival mode, protect the balance sheet, cut the dividend, try to protect the dividend, etc. The last thing you're doing in an imploding oil price is investing in new productive capacity. It's the easiest thing to cut. Exploration first and then new projects. And so now that we've largely harvested most of the projects, not all, but most, that were sanctioned in an $80, $90, $100 world, with a base decline rate of about 7 to 10% for offshore at least, there aren't enough new projects coming on to offset the declines of the established base. And so I'm using Bernstein research again, where they did an exhaustive, like company by company, country by country, basin by basin analysis. And they believe that global offshore non-OPEC production is basically going to flatline until 2030 at the earliest. And so if you wrap it up on the supply side, ESG worries are not going away. These are wonderful headlines the day after that the IEA report that said, to meet climate goals, not a single new oil project is required. And for the International Energy Agency to display one of the greatest feats of energy ignorance was kind of mind-blowing to me. Demand for oil will continue to grow, and fear-mongering like this is leading the world into the next energy crisis, where suddenly we will wake up one day and realize that we need demand or oil supply growth, and yet companies will say, well, we're investing in renewables. Sorry, you want oil supply now? 4 to 6 years until you get a supply response. And so when we look at where is the road that we're on taking us, despite the incremental barrels coming from OPEC, despite rig count marginally ticking up in the United States, et cetera, we still see global inventories reaching multi-year lows at the end of this year, supporting an oil price approximately where we are. Yes, it's possible that we spike to $80 and such at times in the summer, but I think 70 is a very, very healthy level. It's high enough to allow OPEC to be going concerns. It's healthy to allow the global economy to absorb the incremental barrels coming from them. But with the strong backwardation, it's not high enough to incentivize any loss of discipline, even though I think for all the reasons I talked about, that should be cast in stone, at least for the next couple of years, at which point, frankly, every single barrel U.S. shale can grow is going to be required by the market. So I would pose again the question to you. In a world where demand continues to grow, where U.S. shale growth can maybe satisfy about half of demand growth annually, where OPEC is going to be out of spare capacity by the end of next year, and where certain member countries did add capacity, but then we didn't even talk to the countries that have lost productive capacity due to insufficient investment. Where global offshore, it's 4 to 6 year cycle time. So you spend money today, you don't get a drop of oil for 4 to 6 years. So in 2022, okay, we're absorbing $70, well established. What happens in 2023, in 2024, in 2025, when shale growth is probably moderating at that point, OPEC's out of capacity, global offshore is not growing, where is that incremental barrel going to come from? And so inventories can only draw so far until the market has to act and send a signal. And so if supply cannot act as a balancing mechanism, it will have to be on demand. And therefore, price will have to act as that mechanism to restore balance by killing demand growth. And I saw a report out of Morgan Stanley this morning saying, well, $80 is that price. I don't think history would support that. The work that we've seen is that the elasticity of demand growth is a lot less to a rising oil price than what you may think. And the work that we've done would suggest that oil needs to reach about 6%, the oil burden, so the expense on the global economy being spent on oil needs to reach about 6%, which today would translate to about $120 to $140 per barrel. And so you add into that the exhaustion of spare capacity, et cetera. That's why I see, this is not a 2022 forecast, but ultimately by the end of the cycle, which is 4 to 6 years or longer, the likelihood is we see all-time high oil prices, which leads us into, well, okay, how do you make money from that? And I'm going to wrap this up relatively quickly, and then we've got time for questions. Our strategy, so I run the Ninepoint Energy Fund. It's the top performing energy fund in the world year to date, according to Morningstar. Obviously top performing energy fund in Canada, with largest energy fund in Canada. We have a 100% focus right now on Canada, and not just because I'm established in Toronto, but get access to management teams, et cetera. When you look around the world, Canadian energy stocks are the most mispriced. I saw analysis where Canadian energy stocks are trading at the same valuation as Russian oil stocks. And so I'm going to guess, even with let's have an apolitical conversation, the political risk in Canada is a little less than it would be in Russia right now. We can buy companies, and I've got this in a couple of slides, where I'm paying 2 times cash enterprise value to cash flows, so I'm using their debt as well. I'm buying stocks as we speak. Just bought 2 million more of a company a few minutes ago where I'm paying 2.0 times cash flow and a 35% free cash flow. Now put that into reference. So why Canada? Valuations are the most compelling. At the same time, on the left-hand side, what has plagued Canada for the past couple of years? Insufficient pipeline takeaway capacity. We couldn't get a pipeline built, Keystone XL, et cetera. But with the building of Line 3, which should be line fill in a couple of months, we've got the TMX expansion, which despite a couple months setback due to the migratory pattern of the common day hummingbird, like only in Canada, Canada will in 2 years' time actually be overpiped. And in an environment of moderate to no growth, what that means is we have more than ample takeaway capacity, so tight differentials. And so we think that we'll see about $10 or lower WCS differentials beginning in mid to late 2022, which is not far away. I'm already using 2022 in my valuation work. And tight, will basically be rivaling pipeline economics going forward for the foreseeable future. So that big negative is completely gone. The last thing, and I wrote a column for the Financial Post on this theme, and in fact, it got published the very day that the oil sands came out and announced this, but Canada gets a reputation of having like the dirtiest barrel in the world, which is completely untrue. Canada has the highest environmental standards of any jurisdiction in the planet that produces oil. But yeah, we do produce oil sands. Three quarters of our oil is oil sands. And so you do need to use diluent to make it mobile. You need to generate steam to make it mobile if it's not mining, et cetera. But the world's using like 20-year-old standards to say, well, geez, you've got the highest emissions intensity in the world. Where if you give credit to the fact that the Canadian energy sector is the largest investor in clean tech of any other sector in Canada, where emissions intensity per barrel is already reduced by 33%, the newest projects that have been coming on are actually already below the global average. This isn't like hoping in 10 years from now. This is reality today. And with further steps and offsets, the Canadian oil sands sector has pledged to achieve net zero status by 2050. So we already produce one of the most ethical barrels in the world. So we could actually soon potentially produce one of the lowest emissions intensity barrels in the world as well. Think about like being a supplier of choice, where in a world where demand is going to be growing for at least the next 10 to 15 years, where supply is not, where's the world going to want to get its barrels from, especially in an increasingly woke and ESG powerful world? It's Canada. And so we think that valuations coupled with ESG leadership will allow a re-rating of Canadian energy stocks before other jurisdictions. How do we measure valuations? What gives me confidence to say that they are unbelievably mispriced? I did put in 60 because I prepared these slides a couple of days ago, and oil after Monday crashed. So I wanted to make the point that you don't have to believe in higher oil prices. And frankly, you don't even have to believe in the oil prices you already see on your screen. You can believe in $11 lower than where we are today. And energy stocks are already mispriced. I'm going to go with 70. We're buying companies today in the market at 2 times their enterprise value to cash flow at $70 oil, when they used to trade at 7 to 8. And you'd rightfully say, well, Eric, that's great and all, but there's less capital available. You're one of the last energy funds in the country left. So, the Princeton's selling, etc. You'll never trade at where you used to trade. And I completely agree with that. Multi-year bull market may fix that, but let's just go with the logic. So we use a target multiple of 4 to 6 times, not 7 to 8 for our stocks. And that roughly translates to a 10 to 15% free cash flow yield on an enterprise value basis, which we think in an era of ultra low interest rates, if you can get 10 to 15% dividend per year, that's pretty reasonable. So those are our targets. So if you just believe in what you already see, and if consensus buys into that, we see a doubling or more in many of the stocks that you would see on these screens just to get back to that target multiple. And yet, like this, the ignorance, the energy ignorance that I've talked about so much is clouding people's perception and ability to see what I'm showing you here. I'm frankly boggled that more people don't see what I see. I'm highly optimistic. I just sent an email to some of the patch leaders about this theme. I did an interview this morning on BNN Bloomberg reiterating this point. But the curative for the historic level of apathy that we have in the sector today is meaningful share buybacks. And the great news with that is that that is in the power of every CEO's hands, given the amount of free cash flow being generated by the sector. The very best way that I can demonstrate that is a measurement of how many years would it take of free cash flow at $70 oil, again, $1 lower than where we're trading today. How many years of free cash flow would it take not just to buy back all of the shares outstanding, but also to become debt-free? And the reason why I did this chart was the worry that, well, geez, Eric, what's demand look like in 10 years from now? How can I buy your fund? How can I buy an energy stock? And so if the average company could privatize and become debt-free in 5 years at the current oil price, it makes the worry about what the energy sector looks like in 15 years rather moot. And so the ability of these companies to start launching meaningful share buybacks, again, nullifies the worry of I get asked, well, what happens if the generalist investor doesn't come back to the sector? What do we do then? This is the answer. And I'm confident that we're going to see with Q2 results and increasingly with Q3 and Q4, more and more and more sector-wide meaningful share buybacks, along with dividend increases. We already got one from Prairie Sky this week where they increased their dividend by 38%. Is that unique to that company? No. When I look at valuations today, I refreshed this morning, the Canadian large cap space could afford to pay a 20% dividend today. We're buying companies that can do even better than that, 30 to 40 to 50% dividends today. Now, I'm not saying they're going to do that next year, but if you can get a 10 to 15% per annum dividend of a company that's generating free cash, deleveraging, potentially debt-free, et cetera, call me nuts, but I think that's going to be awfully compelling to the generalist investor in the ultra low yield market where you can go chase clean tech, not as much this year because they've fallen on their faces, but clean tech, other sectors trading at 30 times potential sales or like 100 times EBITDA, or you can come buy a real company trading at 2 times cash flow and a 30 to 40% free cash flow yield. And so I want to give you a quick pitch on the fund that I run, and that's the Ninepoint Energy Fund. I've been running it for 11 or 12 years. It feels like a lot longer. We've had to endure the worst bear market in the history of the energy sector. We've done our best to navigate it. We've had some good years. We've had some not some awesome years. I mentioned this year we're doing pretty good. We're up roughly 92% year to date, #1 performing energy fund according to Morningstar in the world. We were the #1 performing long-only oil and gas energy fund in the world in 2019 as well. So our style is to have a small basket of energy stocks that will maximally benefit from our bullish call on oil. They don't need $100 oil to make a go of it. $70, they're just egregious free cash flow machines. And so our track record, we've endured some rough years. We've had some good years. We're optimistic on the path forward. We provide excellent after fee. Some people ignorantly say, well, geez, your trading fee is really high, 4.5%. How can you justify that? There's a cost of achieving returns of the 92% that we're up this year. And the 92% encompasses all of the fees that it takes to generate that. So to look at anything other than after fee performance, in my mind, is a little moronic. And so we massively justify our value add. We're not going to be talking about individual stocks as we get into compliance and selective disclosure issues, but this should give you a feel for what we own. We were strategic in January of this year when oil was at $48. And we said, we're very confident we're going to see 60 by June. We better go out now and establish strategic positions in companies that will benefit from that view before everybody else wants to. And so what did we do? We went out and bought 9.9% of Athabasca off of Equinor at 18 cents. Stock's at 81 cents today. We went and bought Cardinal. We own roughly 7-8% of the company. Headwater, we're now the largest or second largest investor. We don't show gear on here. It's not a top 10, but gear, we own 9.9 or 9.7% of the company and whatnot. So they're small cap companies. Our weighted average market cap is roughly $1.5 billion. That's the sweet spot where it's not on everybody's radar screens, but that is where the profound mispricing is occurring, where I can go out today. I don't believe I will be able to forever, and go out and buy these things at 2 times cash flow before the masses catch on, where we're going to be printing really good results Q2, exceptional results Q3, because a lot of the horrible hedges that companies entered into late last year are rolling off June 30th. So we're in a much better environment now. We're at $70 oil. We get share buybacks, dividend increases, even from the small guys. And my hope is that that's going to reignite interest in the sector. And then lastly, for anybody, I run a mutual fund, but we also have an energy ETF. It's just another way to get access to the exact same vehicle. It's the same thing. There is zero difference. But for people that want to buy my fund on an ETF basis, we have that option as well. So I spoke for roughly twice as long as I wanted to. I get kind of passionate when it's talking about the energy sector. So I'm sorry for anybody that kind of dozed off, but I just wanted to reaffirm a few key points before we go to question and answer. We are in a multi-year bull market, and in fact, I think the world's heading into an energy crisis in the years ahead. The good news is you do not have to believe a word that I've said to get excited about energy stocks, even though they've had a good rally this year. Energy stock valuations are the lowest that I've ever seen in my entire career, and that level of apathy will not last forever. The curative to that is either to return to the generals who want yield, and that's what the companies are offering, or it's going to be in the hands of the CEOs themselves by using their free cash flow and mounting meaningful share buyback. So with that, thank you very much for your time. I appreciate you dialing in or watching. And I think, Neil, we've got a couple questions that have been submitted.
Yeah, absolutely, Eric. Thank you. And we have a bit of an embarrassment of riches when it comes to the questions. Firstly, thank you, everyone, for turning out in such large numbers. I just checked the attendance, and we've had 700 folks on the call today, which is really just an indication of your interest in the subject. And we had something like 125 questions submitted. So we are absolutely going to disappoint a lot of folks because we can't practically do 125 questions. So let's grab a few here, and we'll get some answers, and then we'll get you on your way. The first question I've got, Eric, is from Matthew out in Vancouver. What kind of catalyst, I know you covered this a little bit, but I think it's worth asking, what kind of catalyst will move shares to recognize the current oil price environment?
Yeah, thank you for the question, and it is a very good one, because I get asked that a lot. It's like, well, geez, Eric, the market can ignore what you're saying. We may believe it, but what if the masses don't, because they're hypnotized by Teslas and EVs and eating bugs and whatnot. And I just want to reiterate the point. The return of the generalist investor, I think, is inevitable. Timing-wise, my hope is it's going to occur with Q2, Q3 results, because we're going to go from modeled free cash flow and forecasts that some of us, the few left, have been putting out, to this is in reality. Do you see this? This is in black and white. This is our bank account. This is how much free cash flow that we're generating. And more importantly, action. This is what we're doing with it. And I'm really kind of pushing that message with CEOs where they need to act. They need to be decisive and go from talk to walk. And so I'm hopeful that that's going to be the curative to get the general sector back in. And the other thing I think is, and I'm not speculating on what other fund managers may do. However, if I was unexposed to this sector, and we're up like 92%, the index is up 40 or so. It's the best, was last time we checked, the best performing sub-index. How do you justify not being there to your CIO or whatnot? How do you justify not having exposure to a sector that's performing so well when every day you're hearing more and more the banging of the drumbeat of improving, like vastly improving macro fundamentals, the reflation trade, inflation trade, or whatever. They're opening up the economy. Delta Airlines saying, their forward bookings are incredible. U.S. miles driven just exceeded 2019 levels this week. Like, what's the remaining excuse here? Delta variant? Like, this too shall pass. So it's going to be very, very difficult. And the performance pressure, I would think, would be rather profound for generalists not to be here, especially when the opportunity, like, I can't make it any clearer. And so while many don't see what I see, that's inevitable.
Thank you. Question from Gary in St. John, New Brunswick. What oil price floor would the oil companies in your fund need to still continue to have great free cash flow?
So I would suggest down to about $55. The sector would be generating enough free cash to make it attractive. If I was to, I'd have to go back to a couple slides, so bear with me. This gives you a nausea here, but here's even at 60. The average company that I track could buy back all of their shares outstanding and pay off their debt in 7.6 years. So that's at 60. Now that starts to fall quickly as you reach the tipping point, like below 60, your free cash flow starts getting negated. So again, that positive rate of change is really quick from 60 to 70. But I would suggest about $55, which I have a challenging time unless there's a new strain that's, the vaccines don't work against and we all repeat, global lockdowns from last year. Barring that, I don't see something that can send oil back down into the 55s. And the people that are I know they'll go nameless, but they're available on social media and such. The fearmongers are just using an antiquated view of the sector to say that we're going to be selling down to the 50s. I challenge their logic, and I can't understand what they're looking at.
And one last one from Abraham in Winnipeg. I know you feel really strongly, and with almost 20 years in this space, you've got a very well-reasoned point, and it's been coming to fruition as we've seen. But his question is, what would you say is the biggest threat to your multi-year bull market call on oil?
Yeah. So let's look at demand. So where could I be wrong to derail demand growth? A global recession depression, because there is, for every 1% change in GDP, there's roughly a 0.4 change in oil consumption. So, if we entered into a global recession depression, that would push things out. Displacement and replacement, I have a really challenging time because despite government's best efforts, there are barriers in reality, whether it's base metal, rare earths, etc., access, the timeline to build out, the ability to retire, population growth, their ability to afford certain things, hydrogen, the cost of scale, the ability of governments to subsidize all of these things. I have a really tough time seeing oil demand growth not enduring for a while. And I would challenge anybody who thinks otherwise to try to justify that to me, because I can't wrap my head around that, and I've spent a lot of time contemplating it. On supply, what price would it take for the global super majors to say, we made a boo-boo? We shouldn't have pivoted away from dirty oil. Demand's going to continue to grow. We just had Siemens say, well, geez, inflationary pressures, we're going to have negative 1% to 2% margins on our wind division. That sounds exciting. So what would it take for those companies to invest back into hydrocarbons? What would it allow for them to face and pivot? And even if they did that, you go sanction an offshore project today, 4 to 6 years. So that's hence why I think there's longevity to this cycle. U.S. shale, we're seeing degradation in average well quality, which means tier 1 inventory is probably being exhausted. Has not been exhausted, but at the margins, you're starting to see that. And so, supply costs are going up, estimated about $66 WTI. What would allow a U.S. company to say, we're going to chase growth even though nobody wants it? Our stocks will fall, we won't get our bonus, and we can't pay you a variable dividend. Maybe. And then this is the biggest cop-out in the world, but another COVID-19 experience where the world's going into government-imposed lockdowns and we're all still doing this and not flying, et cetera, for the foreseeable future. That is a total cop-out, but frankly, that's what I come down to. It's difficult, and it's a dangerous place to be. You always want to have 10 different things where, this is a worry, this is a worry, this is a worry. But a lot of those worries have been taken care of for the past 5 years. That's why we've been stuck in the worst bear market in history, and we've taken care of most of them. So But that's our view. We feel pretty good about the path ahead.
I'm always left with the simple sentence that you've been saying for quite some time, that the fear of peak demand is leading to the reality of peak supply. And I think maybe we'll leave it on that note. Thank you so much for the presentation, and thank you for everyone for joining us. We appreciate that there are lots of things you can do with your time, and that you chose to invest it with us. And as I said, we appreciate it. So we'll wrap things up there. Eric, thank you so much. And everyone, have a great rest of the day.
Thanks, everybody.